Hi everyone. So the next exercise we're going to work on is exercise 23-18. Remember, you can find this on Cengage under the ungraded assignment. And this is the fixed factory overhead cost variance report. So if you're seeing here, it says Tannin Products Incorporated prepared the following factory overhead cost budget for the trim department for July of the current year. So I wanted to go through a couple of things on here. So what they're telling us is during which it expected to use 20,000 hours of production. So they give us indirect factory labor, and you can see what I did here. So they said at 20,000 hours of production. So I took the $46,000, divided it by 20,000 hours, and that gave me a standard rate of $2.30 per hour that we're going to use when we start working on the problem. I did the same thing with indirect factory labor. You see there, it was $12,000. I divided it by 20,000 hours, get a rate of 60 cents per hour. Power and light, indirect materials, $20,000. I divided it by $20,000 and I got a $1 standard rate. So if you're working with your own homework problem right now, you could go through and you could take care of those things now and just pause the video until you figure that out for yourself. Then as we go on, so they give us the total variable overhead cost at 20,000 hours, and then they give us the fixed overhead costs, of course, supervisor salaries, depreciation of plant and equipment, insurance and property taxes. Total fixed overhead cost is $130,000. Now that's not going to change, right? Because our fixed costs always remain the same. And then total factory overhead at this level of production, which was 20,000 hours, was estimated to be $208,000. So they tell us here that Tannin has available 25,000 hours of monthly productive capacity in the trim department under normal business conditions. During July, the trim department actually used 22,000 hours for production. When we get along a little later, we'll see we have 3,000 idle hours. And the actual fixed costs were as budgeted, so they were the same as this right up here. The actual variable overhead for July was as follows. So see, they've given us the actual variable overhead here. And then the next thing I did at the problem was I calculated at what the budget would have been at actual. So I took the rate that I got up here, the $2.30 an hour. I then multiplied $2.30 an hour times the 22,000 hours that we actually used in production for the month to get the budgeted actual costs for indirect factory labor of $50,600. I did the same thing for the power and light. That came to $13,200. And then I did the same thing for power and light, which came to $22,000. So that's going to play in here when I actually fill out my cost report, which I have here on the board. So it says, construct a factory overhead cost variance report for the trim department for July. Enter a favorable variance as a negative number, because remember, favorable means we spent less than we thought we were going to, using a minus sign, and an unfavorable variance as a positive number. If an amount box does not require an entry, leave it blank. Round your interim computations to the nearest cent if required. So I'm going to start filling in the table for us. Now remember where it said actual cost? I'm going to put that here. So my actual cost for indirect factory labor was $49,700. So that's going to go here. So here I'm just taking the information they've already given us and entering it in. $13,000 for power and light, and $24,000 for indirect materials. And I'm going to give us that total $86,700 for our total variable actual factory overhead. Now I'm going to use the numbers that I calculated for each of these items at budget. So the indirect factory labor at budget came to $50,600. So what you can see here is the budgeted amount at actual production is less than the actual cost, right? So I'm going to take the $49,700. I'm going to subtract $50,600 from that. It's a negative number, it's negative 900s. That's a favorable variance. We spent $900 less than we would have at the budgeted amount. I'm gonna do power and light now. Power and light, budgeted actual was $13,200. Again, you can see budget was greater than actual, so I'm gonna subtract I'm gonna take 13,000 minus 13,200. I'm gonna get a negative 200. That's a favorable variance of 200. And then finally, when we get down to indirect materials, that amount was 22,000. So the budgeted total cost would have been $85,800. Here, when I subtract 24,000 from 22,000, I get a positive number. That's going to give me an unfavorable variance of $2,000 because we spent more than we would have at the budgeted cost. And I'm just going to leave these here in our table as we move on. Then, down here under our fixed factory overheads, the fixed factory overhead cost didn't change at all, right? So the problem lets us know that it's supervisor salaries are $54,500, $54,500. Depreciation of plant and equipment is $40,000. Insurance and tax is $35,500. And total fixed factory overhead costs are $130,000. And they want you to put a dollar sign in front of that. Right, and we know that fixed costs don't change regardless of our level of activities. So here it's going to be the same, right? 54,500, 40,000, 35,500, with a total of 130,000. So the next line that we're going to fill out is our total factory overhead costs. So we're going to take the total variable factory overhead, we're going to add total fixed factory overhead, and that's going to give us $216,700. That's actual, right? And then my budget, it would be $215,800. So the next thing it asks us to calculate or to bring down are our total controllable variances. Remember that variable variances are the only ones that we have any control over, because fixed factory overhead and other fixed costs, those are longer term costs, so we can't make changes to that in the short run. So I'm going to bring down my $2,000 unfavorable variance and my $1,100 favorable variance. So it's a net controllable variance. It's going to be an unfavorable variance. So our net controllable variance is going to be $900. So that's what goes there. And then the next thing it asks for is it says idle hours at the standard rate for fixed factory overhead. Okay, so we talked about how we had 3,000 hours of our of idle capacity. But first we have to calculate out what our fixed factory overhead rate is. So here for the fixed factory overhead rate, I'm going to do that over here, fixed factory overhead rate. I'm going to take that $130,000 and I'm going to multiply it by my full capacity hours of 25,000 hours. 130,000 divided by 25,000 hours, that gives me $5.20 per hour. And I can work at 25,000 hours. During the month, we only use 22,000 hours. So we're going to multiply this times our 3,000 idle hours. Right, so that's the 25,000 max minus the 22,000 used. So that's where I get my 3,000 hours. When I multiply those two together, I get making sure my math is right. Comes to $15,600. So I'm going to put this in over here on here. It's going to be $15,600. Since it was idle capacity, it's going to fall under that unfavorable variance, right? Because I had idle capacity. I'm going to add these two together, and I'm going to get a total factory overhead cost variance that's unfavorable of $16,500. So what I would suggest doing is viewing this problem the way I went through it, and then maybe having the YouTube open on your phone while you work it on your own homework assignment, and pause it as you go through each step. Make sure you email me if you have any questions. Have a good day.